Welcome to Earnings Central. In this video, we'll break down Concentrix's second quarter fiscal 2025 earnings. We'll cover key financial performance metrics and dig into insights from the earnings call. All right, let's go. Starting with top-line revenue, the original estimate for Q2 was $2.38 billion. The company actually reported revenue of $2.42 billion, surpassing expectations by 1.7%. This quarterly revenue also marked a 1.7% increase compared to the $2.38 billion reported in the same quarter last year. Moving to adjusted earnings per share, the original estimate for Q2 was $2.75. The company actually reported an EPS of $2.70, falling short of expectations by 1.8%. However, this result reflects a slight increase compared to the $2.69 per share reported in the same quarter last year. Now, let's dive into some additional performance metrics highlighted during the earnings call. Starting with cash generation, Concentrix delivered impressive results with adjusted free cash flow of $200 million in the quarter. This represents a massive $240 million sequential improvement from Q1, showcasing the company's ability to convert earnings into cash. This strong cash generation is particularly noteworthy given the margin pressures the company faced during the quarter, demonstrating the underlying strength of their business model. However, the company did face challenges with profitability metrics. Non-GAAP operating income came in at $304 million, which was below their guidance range. Management attributed this primarily to two factors: their strategic decision to hold labor costs in April when clients paused projects due to tariff concerns, and elevated investments to support accelerated revenue growth in the second half of 2025. While this created near-term pressure, it appears to be a calculated move to strengthen client relationships and position for future growth. The company returned $67 million to shareholders during the quarter, with $45 million coming from share repurchases of approximately 920,000 shares, an average price of $49 per share. The remaining $22 million was distributed through their quarterly dividend. This demonstrates management's confidence in the business fundamentals and their commitment to returning capital to shareholders while maintaining financial flexibility. From a balance sheet perspective, Concentrix made meaningful progress in debt reduction. Total debt stood at approximately $4.9 billion at quarter end, with cash and equivalents of $343 million, bringing net debt to $4.5 billion. The company also made strategic moves to optimize their debt structure, including refinancing portions of their debt on favorable terms and extending their revolving credit facility. Despite the margin pressures, adjusted EBITDA hit $357 million in the quarter, representing a 14.8% margin. While this was below expectations, it's important to note that management expects sequential margin improvement in both Q3 and Q4 as their strategic investments begin to pay off and the temporary tariff-related impacts fade. Perhaps most significantly, the company made a voluntary $150 million principal payment against their term loan that matures in December 2026, reducing that balance to $600 million. This proactive debt reduction, combined with their strong cash generation, demonstrates their commitment to maintaining investment-grade principles and reducing leverage over time. Now, let's shift focus to some of the key insights and takeaways from the earnings call. The most exciting development is how Concentrix's AI strategy is creating competitive advantages. The company is benefiting from a consolidation trend where clients prefer fewer partners with broader capabilities. Their 9 suite of products, combined with third-party AI integrations, is positioning them as a technology solutions provider rather than just a traditional outsourcing company. This differentiation is winning them larger, more complex deals that tend to be stickier and more profitable. The margin pressure in Q2 was largely driven by tariff-related client pauses in April, primarily affecting logistics and manufacturing clients. Rather than downsizing immediately, management made the strategic decision to hold labor costs, betting that projects would resume quickly. This decision, while painful in the short term, appears to have strengthened client relationships and positioned the company to capture additional volume as some competitors pulled back. The company's proprietary AI products are approaching a major inflection point. Management expects their 9 suite, including 9 Hello for full automation and 9 Hero for human augmentation, to be accretive to the business by the end of Q4. They're investing approximately $50 million specifically in their 9 suite development, and importantly, they expect to accelerate revenue growth on these products without increasing spending further. Concentrix's adjacent services portfolio, including data annotation analytics, B2B sales, and AI implementation services, is growing faster than their core business and approaching $1 billion in revenue. This diversification is crucial for long-term growth and demonstrates the company's ability to expand beyond traditional customer experience outsourcing into higher-value technology services. The growth outlook is particularly encouraging, with broad-based pipeline momentum across all geographies and verticals. Management noted improvements in previously weak areas like media and communications, while banking and financial services showed solid growth. Even healthcare is approaching the end of offshore migration headwinds, setting up for better growth ahead. Looking forward, management is confident about margin recovery in the second half of the year. They expect meaningful sequential improvement in both Q3 and Q4 as revenue scales from their upfront investments and their technology suite moves toward profitability. The company raised their full-year constant currency revenue growth guidance to 1% to 2%, showing confidence in their acceleration trajectory. That wraps up our recap of Concentrix's second quarter fiscal 2025 earnings. If you found this recap helpful and want to stay on top of more earnings reports from other companies, don't forget to subscribe. We've got plenty more quick and easy breakdowns coming your way from Earnings Central.